The topic is mostly theory, so we don't get to do any number crunching. The idea of this reading is to give you a perspective on history of finance to some extent. So in this reading they have put forth some of the theories on capital structure which were presented as early as 1958, and then they have proved that why those theories are not relevant anymore, and then they have presented the recent theories which are used for building capital structure. So after finishing the reading, you will have some perspective on how to think about what is the right mix for an organization in terms of how much equity should it target and how much debt it should target. So this is the first gentleman we'll be talking about today. Does anyone know or can anyone guess? Have you seen that movie Shawshank Redemption? So there is a guy who I think commits, the old fellow, Frank, right? No, what's his name? Frank? Yeah. Does he look similar to? No? Anyways, yeah, this is Franco Modigliani. You have already studied some of his work. At level 1, we did a M-squared ratio. Did we? So that was Franco Modigliani and his granddaughter. Now, he was a professor with MIT Sloan Business School throughout his career. And in 85, he received Nobel Award for some of his theories in finance. So his primary work is what we would be studying today, plus he's done some work on economics. The second gentleman is Madan Miller, again a Nobel laureate. He received Nobel in 1990 along with, I'm sure you must have heard the names, along with Harry Markowitz and William Sharpe. So can you guess William Sharpe suna? Sharpe ratio. And Harry Markowitz, portfolio theory, right? So then he shared that Nobel Award in 1990 with these professors. Now, they came up with two set of theories. So in 58, I think they came up with first set of theory on capital structure. They came up with relatively strict set of assumptions, and they mostly commented about what should be the right mix of how much should be the equity, how much should be the debt. So this theory is popularly called as the capital structure irrelevance theory, okay, because their primary premise in this theory was that no matter if you are operating in a very strict set of assumptions, then no matter how much is equity in your organization, how much is debt, the value of the firm is not going to change. Then they came up with one more set of theory 4 or 5 years down the line, where they relaxed one important assumption, and they said that now we can have taxes. And once you have taxes, then what should be the ideal capital structure for the firm? So both in the curriculum and a Schweitzer text, in the introduction they say that the reason why we should be studying these theories today, which are not very relevant anymore, is so that you get a perspective of how people thought about capital structure in the past and then how the thinking has changed over the year. Okay, so let's get started. So this is roughly what we have in the first learning outcome. So we look at their propositions, leverages, taxes, and some of the terminology. So what I have done is I have prepared a nice summary of all the theory testable points, both from the notes and the CFA text. And throughout this reading, I would be asking you to write down these points. So when you revise, you can read through the notes once, and then you can just do it through the notes. Read through the Schweitzer notes once, and then you just do the class notes. So start writing. Proposition 1. There would be 4 boxes in this fashion. So you can 1, 2, 3, 4. So you can prepare them accordingly. 4 quadrants. So first proposition is no taxes. In this proposition, he says that it is irrelevant how you are going to build your capital structure. So there's an analogy of a pie used, where he said how you slice that pie in terms of how much equity, how much debt, doesn't really make sense. The total of the value of equity and debt is always going to be same. So value of firm is unaffected by its capital structure. And therefore the formula here is VL is equal to VU. Can you guess what would be that VL? Value of a levered firm. And VU would be value of unlevered firm. Now you can easily imagine that if he is assuming that we are operating in a no taxes world, that means that interest is not going to get us any tax benefit, right? So that's the primary premise of this theory. But apart from that, he had very restrictive set of assumptions. All those are listed in your notes. So similar to what assumptions we saw in CAPM, right? So frictionless markets, that means unlimited lending and borrowing, easy access to debt. So with those set of assumptions, he was able to prove that whether you take equity or debt, it is not going to change your capital or value of the firm. Now again, proposition 1, but this time it was with taxes. So now the moment taxes get introduced into the capital structure, then what he recommends, then we will have the benefit of interest that will result into tax saving, and therefore to optimize or to reduce your cost, the best capital structure is 100% debt. Right? So again, an extremist approach where he says if there are tax savings, then why not take 100% debt? And then the same formula he modified a little bit, and now the formula says value of levered firm is value of unlevered firm plus the benefit of tax shield, which is T into the D. Are we doing fine here? Now we would go on to the proposition 2. Again, in proposition 2, we would first operate on no taxes environment. Now both proposition 2 is about cost of capital. Proposition 1 was about value of the firm. Understand proposition 2 here carefully. What he said is that we are operating in a no tax environment. He said it is correct to say that cost of debt is going to be cheaper compared to cost of equity, which means that when you start taking more and more debt, ideally what should happen is, even if there are no tax benefit, ideally the weighted average cost of capital should go down. But what happens is when you start taking more amount of debt, the company starts becoming more risky, and because the company is going to become more risky, your cost of equity will start increasing, and it will increase in such a fashion that whatever benefits of lower cost debt that you are getting, those would be offsetted by the higher cost equity, so that the weighted average cost of capital of the firm would remain same. Are you following this? So there is some formula, but we can do some background. You write down this part first. proposition 2, no taxes. Say cost of equity increases linearly as company increases its proportion of debt financing. Are you finished writing this? So now let us say your cost of capital right now at time 0 is 10%. Assuming currently you are an unlevered firm, which means right now that 10% is your cost of equity. You are an unlevered firm, there is no debt on your balance sheet. Now you have decided that you want to also have benefit of debt. So let us say cost of debt is 5%, and the weight of debt as a ratio to capital is going to be 50%. The weight of equity to the capital now is 50%. What is missing in this calculation now is what will happen to your cost of equity. So we would put the standard Vac formula here. The standard Vac formula is cost of equity into 50% plus cost of debt, which is 5% into 50%. Now the condition is that you have to set your Vac same as what it used to be earlier, and then reverse calculate what should be that cost of equity, which will make sure that your weighted average cost of capital is not changing. So can you find out how much would that be? This would be 15. And then this is the formula. He just simplified this formula and then he came up with this particular formula. So if you will see, it gets you the same value. K0 is your original cost 10 plus debt equity. What is the debt equity now? Debt equity 1, and multiplied with the original cost of capital 10% minus cost of debt 5%, the cost of equity is 15%. Is that making sense? So calculate your cost of equity in such a way that your WACC remains the same value. Have you understood this part? Do you want me to repeat this again? Yes? So this formula is for cost of equity. Cost of equity is equal to K0. K0 is what was your cost of capital before introducing debt into the capital structure, the original K0. So K0 plus debt equity ratio multiplied with K0 minus KT. What was your cost of capital earlier? 10% minus cost of debt, which is 5%. So this formula will get us a cost of equity of 15%. And that cost of equity of 15% will again ensure that your weighted average cost of capital is coming to 10%, which is the WACC level prior to bringing in debt into your organization. Are we fine here? So again, see what he's trying to prove with this. He's saying that even if you start increasing the size of debt onto your balance sheet, your cost of equity will increase in such a fashion that it will nullify the effect of lower cost of debt. Make sense? Now, proposition 2 with taxes. Now, this is where he will say that if you have the tax benefit, then you should have 100% debt. And then there's a new formula now which incorporates the benefit of taxes. Now the difference between the first formula and the second formula is this word linearly. So in the first case, your KE increased in such a fashion that it nullified the impact. In the second case, if you put the numbers, the first 10 will remain as it is. Debt equity ratio will remain as it is because we had a ratio of 50-50%. This 5 would be as it is. So there was an additional 5 in the previous case. But this time around, that 5 would also be adjusted by the tax rate. So if you have a 50% tax rate, you would be increasing it only by 2.5. Are you following this? And therefore, higher the proportion of debt in your capital structure, automatically your weighted average cost of capital will come down. Okay, so these are the 4 theories. So what you would remember, the proposition 1 is essentially about value. The proposition 2 is about cost of equity or weighted average cost of capital. If you are in no taxes, then the conclusion would be that it doesn't matter what you do. Whether you have debt or you have equity, the valuation or the WACC would be same. But if you're operating with taxes, then value would be maximized at 100% debt and WACC would be minimized at 100% debt. And then these are the 2 formulas you would want to remember. Cost of equity is equal to K0 plus debt to equity ratio into difference between K0 and KT. And in the second formula, you just adjust the second term with taxes. Are we doing fine here? Moving further, now we'll just run through the theory quickly. Under the assumption of no taxes, transaction cost, bankruptcy cost, the value of the firm is unaffected by the changes in leverages. So no taxes says capital structure irrelevant. Again, no taxes, cost of equity will increase. Tell me. Cost of equity will increase linearly with debt equity ratio. Then proposition 1 with taxes, optimum capital structure is 100% debt. Proposition 2, WACC is minimized at 100% debt. Okay. So next flowchart, again you can make this with me. So in this, it's the same learning outcome. It's an extension of M&M theory. So now what we do in this part, so how the topic is organized. We first did Modigliani and Miller. We understood that's how people thought in the past. Then now in this part, we would do some terminology. different type of cost, and then we would look at the modern theories on capital structure. Okay, so cost and their effect on capital. So the first one is cost of financial distress. What do we assume? Yeah, in this formula, the question is asked, should we assume that cost of debt will remain same? So that's a part of the assumption where he says there is unlimited access to borrowing. Yeah, so can you tell me what would be cost of financial distress? Correct. Priority of claims of debt. Okay. If you go bankrupt, yes. So I think at level 1, do you remember we had discussion on Subiksha case study? And leverages, while discussing, we discussed about Subiksha as to how company could not handle that stressful period of 1 year, and therefore they eventually had to go bankrupt. Right? So that could be thought of as a cost of financial distress, which could have two components. It could be either direct or indirect. So what would be direct? If you are filing for bankruptcy, there is a lot of legal cost attached along with this. Right? So that component is considered as a direct cost of financial distress. Indirect would be, maybe a good example is what happened to Amtech Auto some time back. Right? So they defaulted on some payments, and because of that default, of course, we can easily assume that now their credibility in the market must have been affected negatively. So customers might have lost their trust into the company, and that loss of trust will result into some monetary effect in future. Are we together on this? So cost of financial distress, we will say it could be either direct or indirect. Plus, we also need to consider the probability of financial distress. And in the text they have said, larger the amount of debt on the balance sheet, higher is the probability of distress. So cost of financial distress, we broke it down into two parts, cost and the probability. And then we said cost could be either direct or it could be indirect. Do you want to ask anything on this? In liquidation, you only have to pay to debt? Yeah, they have the priority. Yeah, but here that is also, of course, liquidation is a cost. But when they say direct, what they mean is that if you have to file for bankruptcy, then again from a US market perspective, then filing for bankruptcy itself is quite expensive. So there is a lot of legal cost attached with that, and that legal cost will reduce the value of that company to some extent. So that is the direct cost. And indirect is that if you somehow survive, even then there would be a significant loss of reputation and trust. So then that is the indirect cost of financial distress. Or even if you don't survive, but some company is trying to take you over, because of that indirect cost, the valuation of the company will come down. Everything, yeah. Valuation of everything would be negatively affected. Second one is agency cost of equity. So there are three of them. Manage your space accordingly. Agency cost of equity. Yes, can you guess what is this? Correct. So in a corporate structure, the owners of the business and managers of the business are different people. So the company is managed by the employees or board of directors, and owners are the shareholders. So in a way, the reason why they call this agency, because in a way you are expecting those board of directors to work as agents of the shareholders, right? The job of employees and board of directors is to maximize the value of shareholders. So the agency cost is how do you ensure that the employees are working in the best interest of the shareholders of the company. So that is agency cost. Now, conflict between managers and owners. They have given three subcomponents of this cost. The first one is monitoring cost. So आप यहाँ तक लिख लो. Agency cost of equity. conflict between managers and owners. So the first one is monitoring cost. Can you guess what would this be? Yes. So director fees, okay. So I think the easiest way to think is, why do we have annual general meetings every year? Right? Every company will have AGM. Why do they need to have those AGMs every year? Because then in that meeting, shareholders would be given a review of what the company has been able to do for the last year and what they plan to do for next year. So that ways shareholders will be able to monitor what the company is doing. That is a simplified version of monitoring cost. Make sense? Right. Second is the bonding cost. So bonding cost, they've said the cost so that shareholders and the management is bonded together, or they are working in the best interest. So I have also put an example here. Implicit cost associated with non-compete agreements. Implicit cost associated with non-compete agreements. So see, it works like this. Let us say you were CEO of a FMCG segment company for a few years. And then what a lot of CEOs prefer to do is, once they retire, they sit on to board of different companies. But then if you are CEO of a company and you sit on to the board of a competing company, then you might share all the business secrets or trade secrets. So most of these level of employees will typically have non-compete agreements, right? So wherein they would not be allowed to work with a competing firm for a few years after their retirement. And if you want them to sign these type of agreements, then of course the compensation level expected should be relatively higher. So these costs in the text they have referred to as bonding cost. And then what they've said is, no matter how much restrictions you put, there would still be some amount of losses because of this friction. So that component they have called as residual losses. Now I don't expect that there would be a complete case study on this reading. It's very unlikely. But what might happen is, it could be a part of a larger case study. So there might be a capital budgeting case study in which one or two questions in the center would be on these theories. So it's important for you that you remember the meaning of these terms. There is one more sentence I want you to write down. You can write it below this. Use of debt forces manager to be disciplined and therefore reduces agency cost. So see again. A lot of companies do not take debt because you would hear the word very frequently that they want to have flexibility with their set of operations. But imagine if you take debt, it comes with a very strong set of covenants, right? And the bankers will have access to your insider data. They will understand how you're operating. There would be a thorough audit of your processes. There would be credit rating that you would be going through, which means that since you're bringing in bankers into the overall system of or overall architecture, you would tend to be more disciplined with payment of your regular cash flows. And therefore they've said that if you are bringing in debt, that means you are showing the commitment to make regular payments, and therefore the agency cost would be reduced to some extent. Are we doing fine here? You don't agree? Get this part? No, not necessarily the monitoring cost. When they say agency cost, they mean that so it's like this. Imagine you have a company. I put my equity into your company, right? So now if you are a manager and I am a shareholder, there is a friction between us. Friction in terms of I want to be ensured that you're working in best interest and there are no loopholes in the system or no money being exploited. But imagine if there is a banker sitting on top of you, then that will force you to be more disciplined because your data would be disclosed to bankers, plus you'll have to make scheduled payment. So if there's a banker there, then my level of confidence would be slightly better than a no banker scenario. So that's what they say here, that debt will force you to be more disciplined and therefore reduction in the agency cost. Should we go ahead? Next one, cost of asymmetric information. Now this is again to some extent similar to point number 2. What they say in this, that managers will have access to more information compared to the shareholders, and therefore shareholders will always look for some signals given by the managers. Managers will always have access to more information than shareholders, so shareholders will keep on looking for signals. For example, if a company decided to buy back its shares in the market, have you seen that most of the time it is taken as a positive news in the markets? Because if a company is buying back, then what you think as a shareholder, maybe the management perceives that their shares are undervalued. And that's the reason why they're trying to buy back, which means maybe the shares are undervalued right now, we should buy. So in the same fashion, if the company decides to come up with a FPO, right, they decide that they want to issue shares again. Kal parson news tha na SBI ka? So if the company decides to issue shares again, then shareholder might think that maybe company thinks that the shares are right now overvalued. As per this theory, that shares are overvalued, and that's why company is trying to issue more shares. So then this is what this cost of asymmetric information says. It says shareholders will always try to look for signals. So you can write down these points. Cost associated with managers having more information than shareholders. Cost associated with managers having more information than shareholders. Below that you would say investors will look for signals. Okay, so they have also elaborated on certain signals in the curriculum or in the CFA text. So if a firm decides to issue equity, it would be considered as a negative signal. But if it decides to raise money through debt, it would be considered as a positive signal, because it shows that management is committed or management is disciplined to make those scheduled payments. Okay, so some of the important signals that you should have in your notes. Taking more debt, please write, is positive signal, shows managers' commitment. Taking more debt is positive signal. Positive signal shows managers' commitment. Issuing equity is a negative signal. Management thinks that the stock is overvalued. Issuing equity, negative signal. Management thinks that the stock is overvalued. Then last sentence, all of these are highly testable for a theory question. Last sentence, cost of asymmetric information increases with equity proportion in capital. Cost of asymmetric information increases with equity proportions in capital. So this is just one cost, asymmetric information. So the question he asked, there are some companies which have taken foreign currency debts and they are trying to convert that to equities, and markets are looking at it as a positive signal. So we can link it to what we learned earlier. Higher amount of debt resulted into higher cost of financial distress. Right? And that higher cost of financial distress, when they reduce that to equity, the cost of financial distress reduced, the cost of asymmetric information according to this theory increased. Right? Trade-off worked in their favor. See, in this I got to participate in an interesting, so in fact I was doing a session on series of sessions on risk management with a listed company in Pune, and for the first session we invited CFO to do introductory part, and that's where he was discussing about all this cost, and he said that India has 176 or 79th ranking in terms of implementation of the legal agreements. For example, if you have legal agreement between two parties, then whether those parties will comply with those terms of the agreement, we have the lowest rank. We are much more below than many of the African countries. And then that CFO was having this discussion with one of the FII who had a major shareholding in their company. And he asked that FII investor, I said, if this is the case in India, then why are you people, this was of course some time back, so why you people were investing in India? And his answer was again on these lines. He said that majority of Indian companies are family owned, or at least the ones where they invested. And because they were family owned, to some extent they had a relative safety factor that the manager will try to work in the best interest, because their managers and the owners are same people. समझ में आ रहा है ना? जैसे ले लो विप्रो ले लो, है ना? So you take Wipro, so you know that the managers and owners to some extent are same, and therefore there is some reduction in the agency cost. Are we good? Any questions you want to ask here? Should we go ahead? Okay. So again, flowcharts. There are two theories. So there is some writing work for another 15 minutes. So divide your page into two parts: pecking order theory and static trade-off theory. I would be asking you questions towards the end of the session, so be alert. This pecking order theory that you see on the left, it is built on the cost of asymmetric information. So if you remember this point, you would be easily be able to remember pecking order theory. So cost of asymmetric information क्या कह रहा था? If you take debt, it's a positive signal. If you issue equity, it's a negative signal. So in pecking order theory, they have given the preference of the managers, that if a company wants to raise money, then what is the sequence or what is the preference in which they would want to raise. So the first preference is your internally generated finances. That means your retained earnings. Because when you have retained earnings, technically you're not giving any sort of signal to the investors. The second preference would be debt. And then the third preference would be, or the last preference would be, raising money through equity. So this is pecking order theory based on asymmetric information. Based on asymmetric information. Second sentence, if you don't want to write, that's fine. Managers prefer to make financing choices that are least likely to send signal to the investors. You can avoid writing this. And then this is the preference. Number one, internally generated equity. Second, debt. And third, external equity. Finished writing? Now to some extent, these theories are contradictory. Can you read the last sentence of your asymmetric information cost? Cost increases with proportion of equity. And then read preference number one, internally generated. So there is some contradiction here, because if the preference is internally generated equity, then of course your proportion of equity will increase, which will result into increase in cost of asymmetric information. But then you have to take it with a pinch of salt. You will have to remember these small points. Static trade-off theory. So this is the theory that they've said, based on which most of the modern capital structure thinking goes in. And then you can clearly see that it uses the word trade-off. That means at some stage we have to use optimization here. The trade-off is between the reduced cost of debt and increasing cost of equity. What they say in this is that when you start increasing the debt in your capital structure, you have benefit of Vac, because cost of debt is assumed to be cheaper, plus you will have benefit of taxes. But the more debt you would start increasing, at some stage your cost of financial distress will start increasing. That cost of financial distress will result into increased cost of equity. So a manager should try to find out that optimal point at which the benefit of reduction of cost of debt is more than the increase of cost of financial distress, and that should be the optimal capital structure. Are you following this? So we need to balance the cost of financial distress with benefit of tax shield. Balance the cost of financial distress with the benefits of tax shield. Optimum capital structure is when Vac is minimized. Optimal capital structure is when WACC is minimized. And again, it's a continuation of the previous formula that we saw, Modigliani and Miller, without taxes. But there is an addition to the formula. Value of levered firm is equal to unlevered firm plus the benefit of tax shield minus present value of cost of financial distress. So you can link this to a little bit of economics you did at level 1. The maximum profit point is where your marginal cost and marginal revenue is same. In the same fashion, every incremental unit of debt will result in some benefit here and some benefit here. You would keep on going forward till the time you maximize that benefit. You should stop at a level where this portion starts increasing beyond this portion. Are you following this? So when you start increasing debt, this is going to increase and this is going to increase. The optimal point is going to be that point where the difference between these two is maximized. How will it affect its what? I mean, you're asking me how much dividend should be paid?
Correct, because if
I'll tell you how I would think of this is, if I'm in the corporate finance team, the starting point would be you typically look at what's the trend. Okay, because now this is capital structure from Vac minimization perspective, but capital structure has a lot of other perspective. For example, number one, a lot of companies remain pure equity or went pure equity in the last few years because the value investment is currently supposed to be the hot thing. Right? So many companies which otherwise would have benefited, even engineering sector companies, right, which otherwise would have benefited by having some debt, they eliminated debt and they went pure equity. Right? So that could be one perspective how people think these days. Second is you would try to come up with a target number. So maybe let's say the industry trend is 40% debt, 60% equity, and then you manage, then you reverse calculate and decide how much dividend you can afford to pay, and then reverse calculate and also decide how much dividend you can afford to pay consistently. And as we saw in case of, to some of you I might have shown this example, Hero Motocorp. Did we see where dividends were 14, 17 and then directly 104, 103. Now what mistake they did then, that in those couple of years, the payout ratio increased beyond 100%. Right? One of the year the payout ratio was 103, 104%. But subsequent years, after those 2-3 years, they struggled. Right? And the payout ratio again came down significantly. Market took it negatively. So dividend plus capital structure, I think it's a very, very broad area. I mean, you don't just take decision on one factor at a time. But yes, to answer your question very specifically, if you have excess cash and you want to decide how much dividend is to be paid, in theory, the calculation would be you would decide what would be the valuation of my firm next year, how much debt do I need on the balance sheet, how much equity do I need on the balance sheet, how much retained earnings, and therefore remaining amount dividend. Are we good to go ahead? It is significantly, isn't it? What's the stock price now? Stock price is 40. Okay. So Amtech Auto stock price is 40. How much HUL is trading for right now? 800 के आसपास. HUL is 800. Now let's say you have some amount to be invested into either of these stocks. If you invest in HUL, how much will you expect to earn? How much? How much as an investor, how much will you expect to earn? 15%? Yeah, that's a very good expectation. Yeah, so you're a bullish investor. And if you invest in Amtech, will you be okay with 15? No. Why? Risky stock. So how much will you expect? 50%? So then cost of financial distress. Right? And essentially how it works is, if 40 becomes 44 by the end of the year, as an investor you're not happy. And because you said सिर्फ 10% मिला है, you took position into a risky stock, you'd expect to earn more. And if you're not happy, you exit. and if you exit, it again pushes the price downwards. If it pushes the price downward, then the value of the shareholders reduces, and then the ultimate objective of financial management is, the ultimate objective is wealth maximization. Are we good to go now? Okay. Cost of financial distress, another 15 minutes, then we would be done with this. Cost of financial distress is the increased cost companies face when earnings decline and company has trouble paying its fixed cost. Higher amount of leverages result in greater expected cost of financial distress. The agency cost is associated with conflict of interest between management and shareholders. So 3 components: monitoring, bonding, third bolo, residual losses. Asymmetric information, it increases as the amount of equity in the capital structure increases. Pecking order theory, we know the sequence. Static trade-off theory, I'm sure you know what is the balance.